Hello, and welcome to Macro Minutes. During each episode, we will be joined by RBC Capital Markets experts to provide high-conviction insights on the latest developments in financial markets and the global economy. Please listen to the end of this recording for important disclosures.
Hello and welcome to this latest edition of RBC's European Macro Minutes podcast. My name is Cathal and I will be your host for this month's edition, which we're recording on the afternoon of Thursday, June 11th, in the wake of the ECB's decision to raise its benchmark interest rate by 25 basis points. With me today is Peter Schaffrik, head of our European Strategy and Economics research team. And Peter, let's go straight to the topic at hand. You've come straight from watching President Lagarde's press conference today, and you've had a little bit of time to digest the decision. What were your kind of takeaways, given it was a move that was widely flagged in advance, I think it's fair to say?
Yeah, I think that's absolutely right, Cathal. Thanks. The decision itself was so well telegraphed. When you look at it, the market was pricing it. The analyst community was forecasting it. We were forecasting it. And essentially pretty much all of the ECB speakers were in subtle and not so subtle ways indicating that rates would go up. Nobody really thought that it would do more than 25 basis points. So, that wasn't really a big decision. Still, I think there was quite a lot to take away. And actually, I think the change in the scenarios that they presented, the forecasts, the rhetoric changes that they had, I think those made for an interesting listen. But you're absolutely right, the rate decision itself wasn't a big deal.
So, given that the forecasts and the scenario sound more interesting than the decision itself, kind of what was the main points you thought was worth flagging from them?
Yeah, so first of all, when you look at the staff forecast, so every quarter they update the staff forecasts, they increased both on headline and on core the inflation forecasts by quite a bit, actually. So even on core, we now have in 26 and in 27 levels that are probably not compatible with the ECB's target. And also the growth revisions to the downside were much smaller than we were expecting. Like, for instance, for this year, they were only reduced by 0.1. We thought that would probably be reduced by 0.3. And Lagarde was making a point that the economy is fairly resilient and will resume growing next year and the year thereafter. So that alone sort of leaves you with a bit of a hawkish taste. Having said that, though, I think they went a bit further because what she also said is that the ECB introduced a new scenario. They've done these scenarios since March, where they introduced a mild scenario, and that mild scenario is below the baseline. And they were changing the rhetoric and were saying that the rate increase is robust. That's the terminology that they used, even in this mild below baseline forecast. So it's very hard to escape the conclusion then that if even in these cases a rate hike is warranted, that the outlook is further to the hawkish side. And then last but not least, she made a point in basically pushing back against those people in the market who were calling for the ECB's hike to be just an insurance hike and said, no, this is not an insurance hike. The scenarios that we paint warrants it, and which also leads me to conclude that even in a super optimistic scenario, they would not reverse it. So if you take all of these things together, I think you're not only left with the rate hike per se, you're also left with sort of a little bit of a hawkish tilt in the takeaway.
That's interesting. As you say, kind of coming into the meeting, the ECB's communication have been very much focused on today's decision. So, just taking it, obviously they're saying very explicitly they're not done yet and this is not an insurance hike. So what's your take on the outlook for policy from here?
Yeah, so I think going into the meeting, what I said to clients is that there's two things that we should really be watching out for. One is any steer on the total magnitude of rate hikes, and the second one is on the timing, because that's still a very unclear path. Now, she hasn't really given us anything on this, on the latter part, on the timing. So the market is very undecided whether the ECB will go essentially back to back and will hike again in July, or whether they will wait until September, or indeed what they're going to do thereafter, and whether it's going to be a smooth path to 3 hikes. So the market's overall assessment is it's somewhere between 2 and 3. That has been the case for quite some time, and we think that this is probably going to stay unchanged. Whether or not they really wait, as we think, whether they wait until September, that's a much, much harder question to answer. And the market is currently pricing it at about 10 basis points, so not quite 50-50, but almost. That we haven't really learned anything. So I think the market will really stay on tenterhooks as far as the timing is concerned until we get a better steer either from the data or from ECB speakers.
And what's your own view? I mean, coming into this, you had a call for 2 further rate hikes in September and December. You sticking with that?
Yeah, we stick with that. Although, I mean, we made it quite clear at the time, and I think nothing has really changed, that the first 2, so one was delivered now and another one we think in September, that's a relatively safe call. Going back to what I said at the beginning, when you think about it, the ECB is forecasting inflation above target, that the growth dent is not going to be that severe, which, by the way, is also our own assessment. And when you listen to what she's saying about no insurance hike and that even in the mild scenario, the hike is warranted, like all of these things taken together, for me, strongly indicate that they would go again. And particularly when you think about it, their main message is, or has been and continues to be, that it's not about inflation in the here and now, and the first round effect is really about the risk of second round effects, and they clearly bake that into the forecast. So, I would put my hand almost into the fire and say another hike is coming probably in September. Thereafter, obviously, the situation becomes a bit more uncertain. A, because it's quite far out, and secondly, I mean, the situation in the Middle East is very uncertain. Having said that, though, when you look at what our commodities team are saying, they stress that the risk that the conflict is going to be prolonged is quite high. They also point out that we're currently, in terms of price finding in the energy markets, are cushioned by the release of oil reserves. That can't last forever, and somewhere in the autumn, and that's probably going to run out of steam. So unless we find a solution very, very quickly and then start easing the tensions in the energy markets, I think if we come into, or rather out of the summer, we'll probably find, or the ECB will find itself in a position where those inflationary concerns have not really gone away. And as a consequence, I certainly think that the risk for even a third hike in December is surely there for sure. Now, Cathal, if you don't mind, we've now talked a lot about the ECB, but after the ECB is before the Bank of England, and you've just put your preview out. What are your expectations for the Bank of England next week then?
The preview, we went out yesterday. Hopefully people have had a chance to read through it. We're expecting a kind of a hold from the bank this month. I think if you look at the evolution of the MPC's rhetoric since March, it really has softened noticeably. And then coming out of April and everything that's been said since, it very much feels like the MPC, or at least majority of the MPC, are in a kind of a wait and see mode. For me, the key communication going into this meeting was the governor's speech in Reykjavik, in which he discussed the flexibility that the bank's remit allows it, the MPC's remit, I should say, allows it in terms of the speed at which it can return inflation to target. Essentially, it can tolerate a bit of above target inflation if it thinks the cost of bringing it back to target in the short term is too high in terms of lost output and employment. So I think that's the core of the bank's argument. It has time, and that time is also due to the fact that there has been a tightening in financial conditions since the outbreak of the war in the UK. You see quoted mortgage interest rates up about 100 basis points since the end of February. And also, the big contrast we often discuss on the desk between the bank and the ECB. The bank's starting from a point at which rates are already restrictive, and also against the backdrop of a weaker economy, probably on balance, but definitely a weaker labour market in the UK. Sort of employment ticking up materially over the last 18 months or so. And the labour market, no matter what indicator you look at, a lot looser than it was in kind of 2021, 2022.
Well, Cathal, if I pick you up on that last point, when I speak to clients, I hear a lot of negativity around the UK. And against that backdrop, and you seem to be alluding to those concerns at least having some merit, do you still feel comfortable with the call that they will actually also hike?
As I mentioned a moment ago, I think at present the bank thinks it has time to react, which will point to a later than currently expected decision. I mean, we have a July hike in our profile still. Although I think kind of that raises questions as to the timing of the rate of when the bank might have to tighten. But I still think the balance of risks for the bank is tilted towards them having to tighten policy at some point this year in response to events in the Middle East. You see the direct effects feeding through the inflation basket now. As we move through the year, we should see the sort of indirect effects beginning to feed through as well. So I don't think there's kind of I think any rate rises for the bank will be modest, which is what Hugh Pill, even the hawks on the MPC, Hugh Pill and Megan Green have called for a modest rate hike. I don't think they need to go as far as kind of you're calling for with the ECB. But at the same time, I do think this balance of risks in terms of the bank is still tilted towards a rate hike this year, even if there is questions akin to the ECB around the timing of that. I think one thing you will also see, I think possibly more interesting thing in this meeting, will be what I expect to be a kind of a re-emergence of that hawk-dove split on the MPC, which we saw throughout last year. You know, we're expecting kind of 2 votes this time for a rate hike. And I think the longer the situation in the Middle East, as you just described, the longer that persists, the more that kind of hawkish cohort in the MPC will come out calling for kind of, calling for rate hikes. But at the moment, I think kind of, certainly the view of the majority on the MPC, if not the MPC entirely, is that they have time to wait before making a decision on how to react.
I guess you just mentioned it, the communication from the bank. We'll probably learn a little bit more about that, but I guess that would take up an entire edition of its own, doesn't it?
Yeah, well, that sounds like a pitch for a future episode of a Macro Minutes, but sadly for today, that's where we'll kind of have to leave things. Thank you, Peter, for joining us. I will now let you get back to putting pen to paper on the write-up of today's ECB. And thanks very much to our listeners for joining us today, and I hope that you will join us again soon for another edition of Macro Minutes.
This content is based on information available at the time it was recorded and is for informational purposes only. It is not an offer to buy or sell or a solicitation, and no recommendations are implied. It is outside the scope of this communication to consider whether it is suitable for you and your financial objectives.